What's going on, traders? It's your boy here, the Forex Amateur, and welcome back to my YouTube channel. So today we're going to do another exciting new video. Hopefully it's going to be educational. Remember, I am not qualified to offer financial or investment advice. Everything I speak about on this is purely my own opinion and my own processes that I use to invest in the Forex markets. I do not recommend any specific trade or action. Any decisions that you make, ensure that you do your own research on your side and you risk cash that you are willing to risk if you go into live trading. So on the last three videos, I've spoken about market structure. We've spoken about how to identify and verify market structure, which essentially means that you're now able to identify, okay, you're in a bullish market, uh, or you're able to identify when a bullish market then becomes bearish, or when a bearish market then becomes bullish. Just to draw a little diagram really quickly, just so that we can communicate the point effectively. All right. So you know that, okay, bullish market, forgive my drawing, right? At this point, you know, you become bearish market and so forth, right? Bullish market is where you become at this point again. So very simple, you're able to identify, all right, that's a higher high, higher low, higher high, higher low, which essentially means that this market is going to the upside. What the hell is that? Which essentially means the market was going to the upside, higher high, higher, higher low, higher high, higher low, higher high, lower low, lower high, which means we failed to make a higher high at this point, which means at this point, the market is now going to the downside. So great, you now have that information. How do you now use this information in order to effectively identify that you can take a trade? As I did say that when you see your structure basically maybe shifting, you then need to look for your additional confirmations in areas of interest, right? In specific areas of interest where you know, okay, this is an area where the market is most likely going to continue in a bullish direction, or most likely going to continue in a bearish direction, or reverse from a bullish direction to bearish, and reverse from a bearish direction into a bullish direction, right? So for instance, if you had to look at this, obviously this market is going to the upside. If you wanted to perfectly position yourself in this bullish trend, you can see that we've obviously broken structure at this point. We've created a higher high, we've pulled back and created a higher low. So you can basically position yourself somewhere in here, maybe look for your engulfing candlesticks, look for your inverted head and shoulders, look for your support, look for your RSI divergence, look for whatever it is, moving average crossovers, or whatever it is that you use to trade as confirmations, and most likely look to get in on your trades from about that point, right? Obviously, at this area here, we created a high, we broke structure, we came back and we failed to make a lower low, which means this would be another area where you would most likely look to position yourself, right? Obviously, then the market continued. We can see we made a higher low, higher high, higher low, and here we failed to make a higher high, which means in this instance, on this pullback, it would not make sense, right? When the market does pull back from here, it would not make sense for you to want to buy again at this point. Why? Because the market failed to make a higher high at this area here, coming off this higher low. So there isn't really much confirmation telling you that there's enough momentum still sitting in this move for the market to make a higher high. That doesn't necessarily mean that the market will not make a higher high, but it's of lower probability that it would, right? Remember, we're playing in a probability game. Obviously, market comes off here and it makes a higher high. You're sitting there feeling bad for yourself and you're thinking, okay, when the market comes back, we can get in on another trade. Now, there's nothing wrong. Bear in mind, there is nothing wrong with taking another buy at that point. If you're being systematic and you're following your process and it gives you enough confirmations, then you would most likely take a buy in this area and you would most likely get stopped out in this push to the downside, which is okay. It's okay to take a loss as long as you have followed your process. That is why I initially said that in these areas here, even though you know that these are your higher probability entry areas, because of structure breaks and failures to make lower structure, uh, even though you know that, you need to have another layer of confirmation. You can't just jump in based on the fact that the market broke structure and made a higher low. That is why I said look for your engulfing candles or your moving average crossovers or your divergence or your blah de blah. The list goes on. You know, if you are experienced in trading, you need to have a rule book that you follow and a set of tools that you follow in order to effectively make trading decisions, right? If you do follow those things, chances are in this area in here, when the market breaks here, makes a higher high and pulls back, chances are that you are most likely not going to get a confirmation here. And that is how you remove that certain those inconsistencies in terms of taking trades. And that is how you avoid certain losing opportunities like this, right? Not to mention that it's not going to happen every single time. Sometimes you are most likely going to get a confirmation to buy at this area here, and you're most likely going to buy because it broke structure, pulled back, maybe gave you your double bottom. If you trade double bottoms, maybe gave you a bullish engulfing candle, maybe rejected multiple times in this area before it pushed up slightly, or whatever it is that you look for in terms of confirmations. So sometimes you are going to get stopped up, and that's fine, right? Anyway, moving on, we've obviously broken structure to the downside here. We formed a lower low at this area here, pulled back and failed to form a higher high, which would continue the bullish market. Instead, we formed a lower high, right? So that is now telling us that this market is most likely going to head to the downside, coupled with the fact that momentum slowed down in this area before this last impulse to the upside and then a break of structure to the downside. Coupled with that information, it would still be safe for you to start looking for sells in that area in there, right? So very simple, now able to identify these little things. And obviously I'm going to do some chart examples where you can look at this on the charts and we can have a look at that before we move into the next conversation that I want to speak about, right? Or should I think let me actually do this, right? Let's go into the charts now and let's look at a few examples. What chart should I look at? Just give me a second. Okay, let's go to a currency chart. Even though I prefer to trade volatility indices, let's go into a currency chart. Should I look at what should I look at? What should I look at? Let's look at AUD USD, right? So this is basically the charts that I do watch. These two, which is dollar index and fiber, right? Those are the two charts that I love to trade because of the strong correlation between the two. But obviously, I'm looking to add another instrument to my watch list because I trade volatility indices and I trade currencies as of the past 2 months. So I'm just currently testing on AUD USD, but AUD USD is a really, really structured environment, right? So this is, if you're a beginner, this is a really, really nice chart for you to look to trade, right? Let's move on to the 1 hour chart because obviously we'll have a lot of structure in the 1 hour chart. And this looks like a nice bit of a nice price action segment in here that has a lot of structure in it, right? And let's just go through this structure really quickly. And I think that will pretty much cover the video for today. And we'll go into the next topic perhaps later on in the week, or we'll perhaps start the new topic from the new week going forward. We'll do a few examples of this topic, right? So looking at this, right, we're on the 1 hour chart on AUD USD, and we can see what happened here. Let's forget about what happened to the left-hand side of the chart, and let's just focus on what information we've got in here. Now we can obviously see a high here, and we can see a low here, right? Notice, so whenever I speak about structure and stuff like that, I always start with the first high and low that is formed is always just a high or it's just a low, because the only time you can have a higher high is if you have a point of reference, right? You have a high before it that you can refer to. Like for instance, in this area here, this is a higher high, right? Why is it a higher high? Because if you compare it to the previous high that was formed in this market, this is higher, right? So the only time you can have a higher high or lower high or a higher low or lower low is if you have a low or high to the left-hand side of it to compare to refer to, right, as a point of reference. In this instance here, we do not have any information to the left-hand side of the chart. So we know that this is just a high, right, swing high, if you want to call it that, and that is just a low, right? Now, based on our market structure, this is basically our points of reference, right? If price were to break below here, then it would make a lower low. If price is to break above here, which it obviously did in this instance, it would make a higher high, right? So let's move on with this and let's look at it. So price obviously broke above this area in here, right? Now you can obviously look at these smaller swings inside of here and say, this is a high, this is a low, that is a high. But I don't essentially look at that. I look at this entire thing as a swing. Now in this instance here, price pushed to the upside. Obviously, if you were looking at the interim swings, you can't only start looking at it from there. You obviously have to start looking at it from this point in here, which means that you would look at that as a high, that as a low, that as a high, that as a low. So basically this would be a high, low, or a lower high, if you want to call it that, compared to that. This will be a higher low compared to that. This will be a higher high compared to this, and this will be a lower low. So this is, now you would understand, this basically complicates it a bit more than it needs to. And that is why I do not look at these internal swings unless I'm looking at a lower time frame chart, right? So in this instance here, I would obviously look at that swing as a higher high, right? The reason I drew this arrow here is because we're comparing it to the previous high, and this is a higher high, right? Looking at this area in here, what is this? Compare it to the previous reference point, this will be a higher low, right? So we're able to identify at this point here. Let's look at our three rule process that we spoke about when we spoke about the bullish market structure video. So we said price has to be making higher highs and higher lows, has to break a previous high, right? And respect a previous low, right? Do you see how all three rules were met in this specific instance, right? So I'm just going to remove all of this and we're going to go through it again. Change the color of the pen. So price broke previous high, right? So that's the previous high. That's number one, right? Price formed a higher high. That's number two. Formed a higher low and respected the previous low, right? So this, you can even look at this as the previous low if you'd like. But for me, this is the previous low. Price did not come back down and break below it. So number three has been met at this point. So from this point going onwards, all you are looking for is buying opportunities in this market, right? All you're looking for is buying opportunities in this market. And let's just take this a step further and let's add, let's look at some things that people would use for confirmations to buy, right? Let's add an oscillator on here. I know the one that everybody knows is the RSI, so let's add the RSI on here. Let's make it black, dark blue. Right, let's remove all of this off the chart. All right, so looking at that, we identified at this point in here that the market is bullish, right? Because it made a higher high and made a higher low, broke market structure at this point and respected this previous low at that point, right? So that is our structure level. Now, if you're a support and resistance trader, for instance, what you would do in this instance is perhaps draw out a level of support in here, right? And from this next level, remember, if you do not know what I'm doing at this point, just go back and watch the bullish market structure video that I did last week. And I did mention that the previous high that is broken, which is this one, and the low that is formed prior to that becomes some sort of a support zone, right? Becomes some sort of a support zone. So if you're a support and resistance trader, for instance, you can look at this, and this is a what? This is some sort of a support zone, right? Because in this area in here, you can see we've taken from the high. So this was the higher high that was formed. This was the higher low. What happened after the higher low? Price traded up, broke market structure, right? Let's take a pen again. At this point, price broke market structure. What did it do? It formed a higher high in that area, pulled back and formed a higher low in that area. And what else did it do? It respected the previous low, which would have been this one, right? So in this area here, we've got number 1 there, we've got number 2 there, and we've got number 3. So a simple 3-step rule that you can use in order to identify and validate or verify your structure, thereby using it to take your trades. So once you've identified those two, this now becomes your support zone, right? This now becomes your area of interest, which means when price gets back into this area, all you're looking for is to take buys. So you can see in this area here, what do we have in these areas that we could most likely look at for to take trades, right? Let's just clear this up now. And that's our support zone. So what do you have in these areas? Firstly, that most people use. Now, bear in mind that I do not use these specific confirmation tools, right? But they are broad-based tools, which means that most likely everybody does know about them, right? So looking at this area here, we see price form that higher high in there. We see it came down into this area here. Now, what can you notice about this area specifically? We've got price coming down, pushing up, coming back down, and pushing up again from that area, right? So for instance, this would be one of the tools that someone would use to take a trade, right? Number 1, this would be one of those tools. So you can look at it as a double bottom, right? This would be one of the tools that people would use to take a trade, a double bottom. Let's just move it down here, and I'm just going to list them all as we go into it here, right? So that's the first one that we can see. We can clearly identify a double bottom in this area here, right? Which means that at this specific point here, I'm not sure how people enter double bottoms. The generic way that I normally hear about is you wait for the break above that neckline and a retest. Perhaps you can consider that as the break above and the retest, or you can consider that as the break above and the retest, which means at this point in here, you would most likely look to enter here, maybe a stop loss below here or a stop loss below there. I'm not really sure. That's not really within the scope of this conversation. And then you target something up here. I don't know how the targeting would work, maybe a 1-to-2 or 1-to-3 risk to reward ratio or whatever it is, right? So that's the first thing that you could look at in this instance to take a trade. That's the first thing you could look at. What's the second thing that we can notice about this area? If you look at this as a support and resistance, you can also look at candlestick confirmations to be able to take a trade, right? What do we notice about this area? We can see, okay, price came back in here, bounced up, didn't give us any significant thing, but we can look at this as a rejection, right? Price pulled back into it and rejected again. After rejecting again, what did it do in this specific area here? We can see this as a bullish engulfing candle, right? That is a second confirmation that you could use to take a trade at that area. Number 2, bullish engulfing. I'm just going to put it as bullish engulfing. Dude, come on, what's going on? Engulfing. All right, so in this area here, we can identify a bullish engulfing candle. I'm not really sure how people use these to enter, right? Obviously, the generic way that oh wow, why did you just do that? Hate it when that happens. Okay, there we go. Bullish engulfing, right? The generic way that I know of or that I've heard of or maybe might have used before is once you get your bullish engulfing candle closed, you can either drop down to a lower time frame and you can look at a retest, right? Because inside of here is a resistance formed in there, right? Price obviously broke the resistance with this bullish engulfing candle. So you can enter at the resistance, which will then become broken resistance, becomes support. So you can enter somewhere in there, put a stop loss below here, and then target something here to the upside. I'm not really sure how you would use your targeting, right? So that's the second thing that we've noticed about that. Very simple, very straightforward. You've now got two confirmations in this area. You can even use them in conjunction with each other. You can use the double bottom in conjunction with the bullish engulfing candle, get one entry at this area, get another entry at that area. You could even do that. That's called confluence trading. Moving on from that, what else do we notice in this area that would most likely give us confirmations to take a trade? What we notice about it is price pushed down here, price pushed down into here, price pushed down into here, and then went up. What is this? So here we've got one touch, here we've got another touch, here we've got another touch, right? So what do we notice about this? This is a number 3, inverse head and shoulders, right? That's an inverse head and shoulders that we could most likely use to take a trade as well. So that's another thing. Another confirmation, that's confirmation number 3 that you could look at in that specific area that you could use to take a trade, right? Looking at that, I'm not really sure how people enter again using inverse head and shoulders. Some people would look at entering at this point in here, stop loss below this area here, and target whatever it is above. Some people would look at a break of the neckline, which gives you a much later entry, right? But obviously it's a higher confirmation or whatever it is that people call it. I also do not use this to trade specifically, so I'm just covering what would be broad-based knowledge. Price breaks above here, pulls back into there. Some people would enter at that point, stop loss below this area, and target something, I don't know, further up perhaps, maybe, because this would be a bit too low of a target for anyone. So I think people would generally maybe target this high and then target something further to the upside, right? So looking at that, we've already gotten 3 confirmations in this area that we could use to take a trade. Simply just using our market structure to identify a specific area where the market would most likely react. Yes, this could be a bit late in the trend, right? You would probably be thinking, hey, I want to be here to catch this big move in there. But there isn't enough information in this area here unless you're just going to jump in the middle of the move. Oh, wow, this started moving already. Let me put a buy stop above it and then we look for price to take it. And unfortunately, that is not an efficient way to trade, right? It's going to work out for you a couple of times, but then what you'll notice is after some time, you'll notice that you're losing more often than you're winning, right? Or your wins are so small, right? You're taking wins, but your wins are small, right? So you jump in here, price rejects from there, you see another one in here, you enter here, for instance, or you enter here after price breaks the structure in here and then price moves a little bit and then it starts dropping against you, right? Or look at it from this area here again. Perhaps you notice here, we've got a breakout there, nice strong candle. You enter at that point, price pushes up and then price starts going against you. Again, here, price broke structure, you jump in with a buy stop above price in there and price goes up and then it just dumps against you, right? And this is one of the reasons why there will be inconsistency in your trades, is because you're using that sort of system that doesn't necessarily position you in a good enough area for you to have a high probability of profiting. Bear in mind that what I've covered with you so far in terms of market structure and these 3 confirmations that we've looked at are things that will increase your probability of making profits, making consistent profits. Behind this, on the back of this, you still have to have a effective management structure that's going to give you a good enough upper hand. Like for instance, if you take the head and shoulders and for instance, you jump in on here, maybe something like, okay, when price breaks market structure to the upside, you move your stop loss to break even. So even if price, or you take some of your profits off the table at that point. So even if price comes back and hits your stop loss, it hits you at break even and you've taken some of your profits at that point. In this instance here, your hit rate or your success rate might still be very, very low, but you might find yourself coming out with profitable trades purely because your management process is so strong, right? And it's called something like money management, if I'm not mistaken. I covered it in the risk management video that I did sometime last year, right? Look at something like that. Or you could look at it from a risk to reward point of view. So for instance, you enter here, at the double bottom, wherever it is that you enter at that point or whatever it is, you enter there with your stop loss at that point, and then you could have something like, okay, if price hits 1, 2, 3, risk to reward, right, which means 3 times your risk, which is from here to here. So if price hits 3 times your risk, 1, oh wow, sorry about that, 2, 3, something to that effect. So when price gets to this level in here, you close a portion of your trade, you move your stop loss to break even, or you move your stop loss to 1 time your risk, or you move your stop loss to 2 times your risk, or whatever it is. This would effectively give you an upper hand, which means that you don't have to win more trades. You could still win even 50% or 40% of your trades, right? But you would find that you would come out more profitable than someone who wins more often, right? Because it's all about managing your trade effectively, getting in and getting out at the effective moments, not necessarily focusing on catching the big moves, but catching the highest probability moves and then managing your trade effectively, right? So that's that. Now we can move on from this. I did put the RSI on here. Let's see if we've got anything on the RSI. Okay, we've got this level here. We've got this where the was made, and that's there. Nothing necessarily in terms of divergence in that point. We've got this here that made a lower low, made a lower high. Nothing in divergence in that instance. Nothing in that instance there. That low, that made a lower low, nothing in terms of divergence here. All right, in this instance here, we don't necessarily have any divergence per se that we can look at in this market, right? So in this instance here, the RSI wouldn't really come into it, but I'm not really gonna explain what divergence is at this point. Perhaps at a later stage, I'll do a video and talk about RSI divergence, okay? So now we've seen a bullish scenario. Let's move over to the bearish scenario. So we know that's the higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. What happened at this point? Price then pushed to the downside. What did it do? It broke a previous low. It didn't obviously pull back. You can look at these little swings as lower highs and whatever it is, but it didn't necessarily pull back to give us a trading scenario. So this is not necessarily a good example for the bearish scenario, right? But what we can see in this instance is price broke structure at this area here. If you would like to, you can always drop down to a lower time frame and you can focus on these little swings inside of here, which is something that I do as well. But you need to obviously understand the structure that you're working inside of. Let's see. That's not sure. It would take me a while for me to find this on the lower time frame. Let's look at how far into it we are. Quite deep into it. Let's go to this example. This as an example, right? This looks like a good enough just for the bearish, outlook, right? Now looking at this area in here, what do we have? We have low. This would be a lower low, right? Obviously, because we've got information on the left hand side. We've got a low here. We've got a high there. So this will be a lower low. This will be a lower high. What is this? This is a higher low because in comparison to this previous low, it is higher. This is a higher high. In comparison to this previous high, it is higher, right? So those are good enough structure points. And let's start with that as our structure point. So we've got higher low, higher high, higher low. You can look at this as a higher high, higher low, higher high, right? That means now that from these specific points in here, why do I keep doing this? From this point in here, price breaks that point, we're most likely going bearish. Price breaks this point, we're most likely going bullish. Going bullish doesn't necessarily mean we're going to buy immediately. Obviously, we still need to follow the 3-step process in order to effectively take a trade. But let's just focus on what we've got in here. So looking at this point here, we've got a higher low at this area. At that point, that higher low was broken. Pull back from that higher low. What happened at this area here? Price made a lower high, right? And it failed to go back and make a higher high above the structure, which is what it has been doing this entire way there, right? So looking in this area here, we've got a break, we've got a lower high, price formed a lower low, and it came back again and it respected this lower high multiple times. So looking at that specifically, that is where, what the heck? All right, not sure what happened there. So looking at that specifically, at this point in here, right? So firstly, we have a break of a previous low, right? That's number one, price breaking previous lows. Number two, forming a lower high and a lower low. So that's number two, right? Number three, what is it? Respecting. Can you see how this low, if I were to draw that low out, let's just get a box from here. If I were to draw this low out, can you see how price came into this low? Even though I'm not going to try and crook the system and make it look good or whatever it is, we can clearly see that at this point in here, the wick broke above, right? We can see this specific wick here did break above, which is fine. According to my process, I do not identify this as a break of market structure, right? And I'll speak about that perhaps in a later video as well, how I define broken market structure and respected or rejected market structure. In this instance here, I would identify this as a rejected market structure, right? Now, let's look at this. So now we've identified at this area, we've got 1, 2, 3. Oh, sorry. Hate it. Let's just clear all of this off, right? So we know that market structure was broken here, lower high, lower low was formed there, and respected previous market structure there, right? So this would be number 1, right? This would be number 2, right? And this would be number 3, right? Very simple, very simple. So all we need to know now is that, okay, this was the last broken market structure. This was the last low that was formed. This was the last high that was formed. So between the broken market structure, right, and the lower high, because this is the low that was broken. Remember, I said in the bearish market structure video, the low that was broken and the new high that is formed forms some sort of a resistance zone. If you draw this out in here, you can see very clearly we've got a resistance zone in there, right? And let's look at this resistance zone and let's see what we can identify. This is where you would be looking to take a trade or slightly lower, whatever it is that you use, but I'm just using this for an example so that you are able to identify it. This video is also going to be slightly longer, but I'm trying to put in as much information into here as possible. Right? Let's start off with something very simple in here firstly, right? And this is a good example of divergence in this instance. Now, looking at the RSI in here, we can see what can we notice about the RSI, right? In this area here, price made a low, right? Made a high, came and made a higher low, came and made a higher high, higher low, higher low, higher high, higher high, higher low, higher low, higher high, higher high, right? Higher low, higher low. This was not a higher high, right? This was an equal high to this one, but it made a lower high here on the other side, right? Made a lower high here. That's number 1. Came and made a equal low here, which is fine because that is consistent with that. And then it made a equal high here, but it made a lower high on the RSI, right? So that is already telling us a lot of information, right? Because if we take this off now, so this will be our first confirmation in terms of the RSI. And we're just simply looking, I'm just going to put a line down here so that you can see that it basically lines up, right? From here, here. Is it straight? Yeah, I think that's straight. Forgive me if it's not straight. I think that's straight. That looks quite straight to me. That's not straight. Yeah, that is straight. What is wrong with you, Ryan? Okay, so looking in this area here, what can we notice? We can notice, I'm just going to change the color of the line, right? So we can notice right here, price made equal lows, equal highs across there. And what can we notice about the same exact area is price made lower lows in this area, right? What is it telling you? Basically, your RSI identifies areas of oversold and overbought. So in this area here, it's showing you a slowing down in bullish momentum. It's showing you that bullish momentum is sort of slowing down, right? According to the RSI, even though price is making equal highs here, which you would also consider as slowing down of bullish momentum, my mistake, right? So bullish momentum slowing down in here, and your RSI is now showing you a sign of bearish momentum coming into the market because it's making lower highs, right? So prices, sorry, it's showing you a change in sentiment. The market sentiment is changing to the downside. Now, bear in mind, this is not an ironclad way of looking at the market, right? Because it's not going to work every single time. But in this instance here, it does work really, really well. And it's all about having your underlying circumstances that you would use to identify these things, right? So let's look in here. So number one, Rsi Divergence, right? Given that it's not happening in a specific area where we want it to happen, right? But it's an underlying factor that you can use as a confirmation. Doesn't necessarily mean you need to jump in on a sell immediately. Generally, you would wait for a pullback before you're able to jump in. And that works out very, very well, because if you put your attention in here for a second, I'm not sure what just happened there, but anyway, if you put your attention in here for a second, directly after the RSI divergence, price pushes to the downside, and then it breaks market structure at this point, forms a lower high at that point, forms a lower low at that point, comes back and respects. So right directly after that RSI divergence, we get our three-step confirmation. Oh, wow. Our three-step confirmation in terms of our market structure. I'm just going to write it as MS, right? So that is a really nice one that you can use as an example as well, right? So we can use number two as market structure shift, right? MSM, I'll just call it MSS, sorry, market structure shift, right? So market structure shifted to the bearish side. But anyway, let's look at this inside of here as we did in the bullish example. These two are just something extra that I'm adding on for this specific one, because you can see it very clearly. Let's go into it now. What can we notice about here? So this is our resistance zone, right? And that is between this area here and this area, right? So this is our RZ, resistance zone. You can call it rejection zone. You can call it point of interest. You can call it whatever you like. But anyway, we know that this is the area. What are we looking for? We're looking for confirmations to take sells to the downside. What can we notice about here now? So price broke structure again. So it broke market structure again after forming this high, lower high, right? Let me take the eraser to this. Do it work? No. Right, that's perfect. Sorry, I have a bit of an OCD regarding how neat my charts need to look. So I struggle to focus if it's not quite neat. So looking at this area in here, right? So we know that this is the area where we are looking for our confirmations to take our trades. Firstly, what we notice is obviously that break of structure again before price comes in. Now, this is a good identifier, because this is telling you something very, very important. When price breaks structure, pulls back, and then breaks structure again, this is a good signifier or identifier or indicator that momentum has shifted. So we put it as momentum shift. It's showing you that momentum has shifted, right? Because the first break of market structure can be a fake out. So this first break of market structure in here can be a false break. I'm sure you've seen instances if you trade support and resistance where price comes, rejects, and then blows through, comes back, and then continues to the upside. So the first break of market structure, because this would essentially be a break of a previous low, right? So the first break of market structure, which would be in this example there, can be a false break, right? So when price breaks and then breaks market structure again, which means it broke here and it broke here, it immediately satisfies our three rule process at that point, right? Because it breaks market structure, pulls back, forms a lower high, right? Or respects the previous high, right? And then breaks market structure again, which means that it formed a lower high and a lower low, right? That immediately satisfies our three rule process, and that identifies the momentum has switched to the downside. If any of these things are not quite clear to you, make sure to go back and watch those videos again and make sure that you are able to identify these things, right? So Looking at that in this instance, we have another break of market structure, which is showing a switch of momentum. And then what do we notice about this? Now let's go into the things that everyone would be able to identify in this situation. The very first thing that sticks out to me is a double top, or a triple top, if you want to call it that. I'm not going to call it that because this was our structure point, right? So anything that happens after, I would consider as new structure, right? So I'm going to call it a double top. So we see price push down from this lower high at that point, right? Forms a lower low at this point, and then pulls back into here, pushes away, pulls back into there, and then pushes away at that point, right? So that is a double top that we can identify in that specific area. Why do I keep clearing that off? Right, so that's a double top right there. Now, I'm not really sure, again, how people take double top. Some would enter right there after the rejection, or some would enter right at that point, stop loss above it, or whatever it is, and target something in there, or some would wait for the breakout and the retest to the neckline, which obviously didn't happen in this instance, and then they'd look to sell it, or whatever it is, right? This point, the conversation for today is not about showing you how to take trades, but it's about showing you how to use confluence and bring multiple factors together and use them in the correct way, right? Because it's very important to understand that it's not about what is happening on the charts, right? It's about what happens where, right? It's about what happens where. In this instance here, what happens in this specific area here works in the entire narrative that you've built up on this chart. So when it gives you more bearish identifiers in here, it's a much bigger probability, or a much higher probability, that you would get a better trade, right? So in this instance here, we can see, what do we notice in this instance? We can notice tweezer top in there, or multiple rejections off that top. We can see a bearish engulfing candle. So that would be number 5. Number 5, bearish engulfing. Bear in mind that these are fresh examples. I haven't been through this chart before. I haven't gone through it and identified specific areas. As you've noticed, I scrolled through the chart in front of you, and we were able to identify this. So this is not something that I went through in advance and then said I can use this one. I know how people think. People generally say, he already knew that was going to happen. But anyway, bearish engulfing candle. I mean, if you're thinking that way, then obviously this video is not for you. I would suggest that you find another YouTube channel that works according to what you're looking for, right? So bearish engulfing candle, people would normally enter at the close of the bearish engulfing, stop loss above it, and then target something to the downside. I'm not really sure. Obviously, you can use your back testing or whatever it is, or your rules, to identify those things and take those trades, right? Price obviously goes to the downside. Now, in this area here, what do we also notice this entire area as? We could also look at that as a head and shoulders, right? Look at this specific area in here as your neckline, right? Sorry about that. So look at this entire area as your neckline, right? So that's another confirmation. We might be stretching it a bit. Some people might look at that as stretching it a bit, but this could also be something. I'm not really going to put it on as the 6th thing under here, right? Because for me, I wouldn't consider this a head and shoulders because it's too stretched out. I would have to see it on a higher time frame as a head and shoulders, but on this specific time frame, I wouldn't see this as a head and shoulders. But this, most people would consider this a good enough head and shoulders, right? We've got the head there. We've got a strong support level here, which is showing a good neckline. We've got a pull back into there, and then we've got a break off it, retest, and a double top again right in here. And then we've got it retest one more time, and then it went bearish from that point, right? So that is what we can use in this specific. I can't necessarily see anything else. Let's just see if we can see anything else. Let's see if we can see anything else in this instance. RSI, what we've got on the RSI in here, nothing of interest on the RSI. There's no necessary divergence or anything per se. Let's look at here. This is actually a higher high. Okay, this is actually this is actually a form of divergence, right? So this is called bearish hidden divergence, right? Which where, for instance, here you can see that the RSI made a high and then it made a higher high, right? But price here made a high and then made a lower high, right? So this is showing push to the downside, and this is showing a push to the upside. So this is a form of hidden divergence. Not many people use this or understand this, right? But this is a form of hidden divergence, and it's where the RSI is showing an opposing view in terms of which direction the market is going to switch to, right? In the other example in here, it's showing a view of exactly which way the market's going to go, right? Because it's showing lower lows, and here it's showing equal highs. But in this instance here, it's showing higher highs, and then price is making lower highs, right? So it's showing an opposing view, and this is why most people don't use hidden divergence, but it's also one. So you can look at this as the seventh factor that you could use to take a trade in this area that we've already identified. It's important to understand this area here was identified solely using market structure. We identified this as the shift or the break of market structure, and this is the lower high that was formed. So this is our zone. It's important to understand. So this is our area that we need to see anything happening to take a trade. If it happens down in here, you're more than welcome to take a trade, right? But you're using your narrative from what happened inside of here for you to take a trade. Generally, for me, if you check out any of my screenshots or things like that, you will notice that I'm always looking to take a trade at the highest possible point or higher than that, right? So if this would be my area, I'd be looking to get in right at the wick or right inside of here. I'm not necessarily the type of person to take a trade down here because it's already so far away from my point of interest, right? So anyway, that's it for today's video. It's a relatively long video. If any of this did not make any sense to you, make sure to go back and watch the video again. If you still have anything that you're uncertain about, drop it down in the comments. I've noticed nobody said anything about that, but that's fine. It must mean that I'm a really good mentor or I'm really good at explaining stuff. I'll take it as a compliment. But if there's anything you're uncertain about, be sure to drop it down in the comments. If you do have access to me, I would prefer you not messaging me and stuff like that about the YouTube content and all of that, because remember, I'm not doing this to get any sort of subscription or to get anyone to participate in my services that I offer or whatever it is. I'm simply doing this for educational purposes. So if you watch this video and there's anything you want to know a bit more about or whatever it is, be sure to drop it down in the comments. And when I do get to the comments, I'll be sure to make sure I get back to you or make a video about it. Until next time, I'm wishing you a blessed and a profitable day, and I'll catch up with you on the next YouTube video.